because now if you're an intelligent investor, you can better excel at getting the results you want versus kind of being pushed around with the winds of the market. And that's what happens to a lot of people.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Properties Podcast, here with my co-host, a multifamily mentor, the coach, chef, father, six, a best-selling author, the G-Father. Switching it up today. Gino Barbaro. Gino, how you doing?
Make me feel a little older. I like the G-Daddy a little better, to be honest with you. The father sounds like all-encompassing. I'm omnipresent. I'm omniscient. Dude, we not even close to that, bro.
We got the preacher on the show today, so I had a preacher father, play on words.
There you
so
go. It all works together.
Just let me roll with it, man. So
yeah,
today's,
at the end, I'll have a confession with Gino to kind of absolve myself of all the stuff we've done wrong.
Fair enough. So today's guest is Randy Lawrence, an entrepreneur with over 24 years of experience owning 4 successful real estate investment companies and host of the Real Estate Preacher podcast. There we go for the folks wondering what the heck we're talking about today. Randy is also a pastor and founder of multiple life-changing ministries, and in the last 15 years has impacted over 40,000 people. So without further ado, Randy, welcome.
Indeed. Yes. Thank you so much. Good to be on the show with you guys. Excited to kind of share with the audience and hopefully bring some value of what we've been able to achieve. I think, kind of in my background, I was a pastor for 15 years, owned and operated a money management company where I was a registered investment advisor, 65, licensed 67, Series 7 stockbroker, owned and operated a company, sold that company in 2006. And really since 2003, focused on the real estate, just because of knowing how valuable it is, the returns that can be generated, the security that can be generated. Ultimately, that's why I sold my money management practice and left my licenses with NASD and SEC, because you can just accomplish so much more in real estate. And so now we're at, about 105 million in assets with our company, and, probably bought and sold over 1,000 single family homes over the years. And so just really a vast amount of experience, but always coming at it from a place of how can we serve other people? Because really that's kind of my background where, God's impacted my life, changed my life, and now I can be a vessel to benefit other people. That's kind of the focus that we've operated from.
So Randy, let's dive back into 2003 when you're a wealth management advisor.
Yep.
No wonder why you must have had to find God, because that industry right there, bro, let me tell you, that's a painful industry. So we're all speaking to financial advisors right now. Everyone listening to the Jake and Gino show, they all about financial intelligence. We're all about creating passive income. We're all about multifamily. Talk to me about that space there, because there's a lot of financial advisors who are really confused about really what are they doing? Are they selling products or are they investing? So give me a behind the curtain view.
Behind the curtain, the reality is that it's driven by money. It's driven by what you can make.
Mm-hmm.
I was probably not necessarily the lone wolf, but very few that it's like when you're looking at the array of products that people can sell to their clients, it's like, okay, this one pays this one pays this, and this one pays this. It's like, again, they're not necessarily maybe putting them in a bad product, but it's like, this is the product that pays the most commission to the
shopping
firm.
For themselves,
yes.
Right?
For sure. So like they're looking at it through that lens in quite a number of ways. And so that's ultimately why I became also a registered investment advisor, a fee-based advisor, in addition to being a licensed broker.
Mm-hmm.
But it really is an industry that is rife with people that are, there's good people in it, no doubt, but it is motivated by money. And if people say that they're not, it's just not fully true. Like, it's like, okay, I can make 300,000 going this way, or I can make 50,000 going this way. And it takes a bunch of years to get to the 300. Most people go to the 300, and so it does color how people look. And you see that nowadays, that there's an outgrowth of more registered investment advisory firms or fiduciaries, but even still, quite frankly, most of those fiduciaries, they're getting paid on assets under management, just like my firm, right? But if you say to your client, hey, that's a good investment to invest in that apartment, go put 500,000 in there, that money's now just come out from their fee umbrella and gone over here. And yes, it's great for the client, but they just lost, say, on a 2% fee management contract, $10,000 a year in their fee management. So there is still some conflict that exists, but there are some great firms out there where they genuinely, and I see this, and people work with us in this manner too, where they're managing their portfolio, but they're actively advising, hey, real estate would be a good component for you because, they're really looking out for the best interest of the person. But it's, I think, not as broad.
I want to echo Randy's sentiments there, Jake, for a second. It's just like any other industry. I think if you find a really great financial planner and they're holistic, it's like when you go to a doctor, right? You want a doctor to look at you holistically, spend time with you, ask you questions, create a plan, create goals. What is your end goal? It's not just buying a whole life policy. Whole life is bad. No, whole life is great if you use it for the right vehicle. Real estate is great if you use it for the right vehicle. Gold is great if you use it for the right vehicle. Commodities are great. Stocks are great if you're using them for the right vehicle and if they are teaching you and you're learning and you share those goals. It's just like anything else. It's just like when somebody wants to come and invest with us in the multifamily space. Well, are you willing to keep your money a little bit longer term? We're not turning money over in the next 36 months with our model. So you really need to know when you engage a financial planner if they have your best interest in mind and if they really work through the plan and actually ask you those difficult questions and you're able to sit down and financial intelligence, that's where it comes into play. You need to be able to speak the language. We all talk about insurance being bad. Insurance is what saves you. You have the castle. Insurance is the moat that's saving your assets. So look at it that way. Financial planner can be really important in that aspect of it. And I think most of us go into it just thinking that we're going to give our money to somebody and they're going to make money for us. That's not what we're talking about, right, Randy?
For sure. And that's what I love about you guys and like our show and the podcast. It's like, it's a beginning vehicle for people to be challenged to begin to be responsible to learn, right?
Mm-hmm.
So that they can become an intelligent or cognitive investor. Because really in that space for 15 years, and I've got friends that still run companies in that arena, quite frankly, most people, they come like the doctor and his wife or, the attorney guy, they come, they say, okay, hey, I've got $1.5 million. What do you recommend?
Mm-hmm.
And then the guy puts together this portfolio that most people don't fully understand. They sit down for an hour and a half and go through it. And the person's like, does that make sense? Can you see yourself achieving these goals? And they're like, yeah. And it's just based on a pure trust deal. They don't understand all the mechanics of it. And, that's still rife within the industry. And so
Mm-hmm.
I love it that you guys, like myself, are more like, hey, we want to talk about what this really means, what the
Mm-hmm.
purpose of it is. How does it fit in? Because now if you're an intelligent investor, you can better excel at getting the results you want versus kind of being pushed around with the winds of the market. And that's what
Mm-hmm.
happens to a lot of people. They're like, oh, and even on the real estate side, I see that happen where somebody's like, oh, hey, I heard about this storage. I heard about this. I heard about that. I heard about this. And kind of jumping at a lot of
shiny
different
object
things.
syndrome.
Yeah, for sure. Versus really understanding, like specifically multifamily, how it can benefit them with the depreciation, how it can benefit them with the cash flow, how it can benefit them with the stability that, good Lord, I'm sure like us and you, many of the complexes you've bought have been there 20, 30, 40 years, providing returns, providing housing. It's a stable investment if
Mm-hmm.
approached correctly. So that's the thing. I think I'm in the same camp with you guys. And ultimately, that's one of the things, again, where I sold my company and left that arena is because it just is so slanted to those products in this thing that makes this much money. That's
Mm-hmm.
the deal,
So Randy, what was your first real estate deal? When was your aha moment that like real estate is the space I need to be in?
We bought our first duplex, my wife and I, in 99 and lived in one side, rented the other side out. And I'm like, this is the way to go, right? Real estate.
Randy, did you invest house hacking? Are you the inventor of house hacking? BRRR, whatever the heck that is. Yeah.
Sure.
He's Jake. We got the inventor of CrossFit on. Jake's the inventor of CrossFit, and you're the inventor of Burr. So, damn, this is an amazing show here.
It's an awesome show. Yeah. Well, so it is like, so that was the first place we bought, 2003. As I really was studying the marketplace, comparing to what we're doing in the money management, really saw it's like real estate's a much better vehicle in terms of a reduced beta, meaning the risk-adjusted return compared to the stock portfolio. And so we bought our first small apartment complex, a 7-unit complex, in 2003. Bought that complex, got it signed over from a guy, signed the note over, went down to a bank I work with, refied it out at like about 160 grand, took the $50,000. The place was a dump, but took the 50 grand, started the process, renovating the units, brought it up to value now worth, 350, doubled it in value through the construction. refinanced it, operated it, and then continued that process on of, locating cash flowing properties and buying properties here in the, the mid Florida market. And it was tough right then. And I quite honestly wasn't as focused because, I'm still got the money management company. I'm involved with the ministry, married, creating this company. And it was really just ourselves, my wife and I. We did have other investors investing with us, but it's predominantly us. And at that time in Florida, it was such a white hot market. It was like you had to kind of get what you could get and not throw a fit. You know what I mean? It was just tough. And so we weren't buying the 75, 200 unit complexes at that time, even though my mentors had a couple thousand doors and had those large complexes. We were starting smaller. And so we, continued to add to it. And then probably 2004 really got focused also on buying houses, just because of the money you could make flipping houses was, short-term, quick cash, and a lot of it. And so we focused on that, continued on that probably through the downturn, 2008, 2009. A lot of people ran away from real estate. We stayed through the course of it, created a large short sale company. That was one of the things I really learned in the fire of going through that, is that you've got to be strategic and go with where the market's going and see where that's at. And so for Florida, it was like we were going to face a tsunami of foreclosures. And so that's where, hey, we can serve these people, help them, and also ourselves make money at the time. And so we did that from probably about 9 through 14, just because there was just millions of them. And, then after that started back where we still have a single family residential division that flips about 75 houses a year. And so that kind of continued on. And then probably about 2015, started focusing back on large scale multifamily and really laying the groundwork with our private equity company. And again, this kind of goes back to why are you doing what you're doing? So for us, we determined to be kind of a fully integrated real estate firm. So we control acquisitions, equity, operations, dispositions, fully integrated. And so we were laying the groundwork for that and began buying in, 17. And then we are where we are today at 105 million, and probably 1 or 2 more coming under contract here directly. Again, slowed down with the COVID stuff and, having to make some adjustments for that.
What is the difference between the smaller assets and the bigger assets? Or even more importantly, what were the learning lessons in that first deal?
For sure. Yeah. So, I think that, again, what I would say is you've got to go in knowing with clarity the pathway, the process, and the plan. And so quite frankly, I had not had as clear of a plan as what I should have had, because like even with the construction, I didn't bring in the contractors that just, boom, do it. It's, 10,000 a door, whatever the number is. The place was a wreck. So, but I brought in people, created employees, created a company, and, kind of did it the wrong way, really. And I mean, it still turned out successfully, but it was a painful process because I'm managing employees more versus developing contractors. And that's where I think a lot of people can benefit from mentoring or education, right? Because you can mentor and follow what other people have done successfully and not have to reinvent the wheel. And so, I mean, the number one learning lesson for me would be exactly that. Like, who's doing what you want to do, see how they're doing it successfully, repetitively, not just a one-off deal, but repetitively. Then you've got something you can model and then marry up to what you want to accomplish.
So it sounds like on that first deal, if you had a mentor and you had invested in your education, you probably would have gotten your money back, your investment back threefold, and probably would have
even better. Yeah,
would have accelerated even more, and then you probably would have continued on the road to multifamily. Let's fast forward into the size of the units. What's the difference for you between a small unit and a larger unit? Which one? I mean, I know the answer. I'm going to ask the answer. Which one do you like to do better, and why are bigger units better?
Sure.
Give us the reason why.
The leverage that exists in the economies of scale, like, is just night and day difference. So, so we don't even, I still maybe have 6 or 7 houses left. Every time a tenant moves out, we sell it, right? Because your net return on a house is probably, no matter how good you are, if you're honest, it's 6 to 8%. And where, good Lord, our investors are getting 12 plus tax benefits and all like that out of the multifamily, because you've got the leverage of 100 units. You've got the leverage of having a on-site manager, on-site maintenance, reduced costs, economies of scale where you can reduce your overall cost of supplies you're building in the vacancy where you're, factoring in a 6% vacancy, whereas in houses it's, or even small multi, somebody buys a 4-unit, you got 1 vacancy, you're 25%.
Mm-hmm.
And so, the problem or the challenge for folks is they don't know how to get into it. And that's where the benefit of what you guys do of learning, like, hey, how can I get, because what happens is when they go, holy Christ, it's, $7 million or $10 million. It's a much easier, believable story to buy the 4-plex for $200,000.
Mm-hmm.
And the reality is the work is going to be the work, right? You're still going to have to put the work in. And if you go with the larger asset, you have the greater ability to leverage that and get greater benefit out of it for everybody. Now it's that process of making that change. And that's where, people either can learn that process and walk alongside of a mentor, or, folks that, I've got folks that invest with us where they run a great law firm and the guy loves being a lawyer. He doesn't want to become an active real estate investor, but he loves getting a great return and the benefits that come with owning real estate. And that's where, becoming a passive investor is key for them. And that's also the difference, because there's greater benefits than just buying a rental house down the road, because, that's fraught with the issues and problems of being the landlord manager, and you don't have the economies of scale. And so, where else do you get a 30-year loan at, 3.5%, 4% at 75, 80% LTV other than this arena here? It's a tougher nut to crack on the smaller assets or smaller single family homes.
I like that. So give us some tips on scaling a business, because I know, first of all, it's about mindset, right? Think big, start small. Everyone's got to start somewhere. We start small and we start accumulating assets. And all of a sudden we realize that multifamily is a business. Multifamily's got economies of scale and it's got scalability. Can you give us some tips on how you've scaled your business and how you've been able to bring about these different streams of revenue?
Yeah, for sure. It's, it starts with first knowing the outcome. And again, you're 100% right in the mindset. Tony Robbins says success is 80% psychology, 20% mechanics. And that's truth. It's you've got to have the right mindset going in, knowing it's possible, knowing that I'm going to succeed, knowing I'm going to achieve my outcome, and then really looking at and visualizing what do you want that outcome to be. So for us, I'm a business builder. And so I knew going in, as we're buying these large complexes, we're not just an investor buying a complex, we're building a business that is scaled. We're creating processes for the, acquisitions team, the administrative team, the asset management team. And so that's part of it, is the way you look at it. That's going to be critical. And, doing what's right for you is the first component, right? What I've done, or maybe what you guys are doing, is maybe not the right thing for another person. I have another guy that's a friend of mine. He's done some work for us. And it's he'd like to just make, 150, 200,000, be able to take care of his family and have freedom to travel. And, so that's his model. Our model is, we're building a $100 million net company that is entailing probably anywhere 500 to $1 billion in assets. And our goal is to transform the lives of people that live in our complex. These are people that oftentimes are going to be renters for life. And so that's the one goal. And the second goal is we want to transform the lives financially of the investors that invest with us. And we've had people that have invested with us for 17 years, making double-digit returns and no loss of capital. And it's changed their life. Literally. And so that's our mission. And for me, I'm a builder. And so that's where, other guys are doing this, but I stay focused on what I'm doing. And that's, the thing I mentioned earlier, too many people in I think, Jake, you said it, the shiny object syndrome. They see this guy doing this, and so they do that. And then this guy does that, and so they do that. And it's instead of figuring out what's true for you and then methodically building it out. Look, it's not sexy by any means for you guys listening, right? Everybody wants to be the jackrabbit. Boom, 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 boom. But if you remember the moral of the story, the rabbit lost the race. It's the tortoise that just methodically, day after day, not with much fanfare, just methodically built the thing and won the race. And that's kind of how we approach it in our business. And that's what's yielded the greatest success.
Wow. So there's so many questions I want to ask, but the great Jim Quick says, reasons reap rewards. If you have enough reasons, you're going to get enough rewards. Why are you building a company like this when Joe down the street just is comfortable with $150,000?
Yeah, I mean, it started off, no doubt, for me coming from, broken home. I thought powdered milk was how milk came, right? It's like, no, went to a friend's house, like, wow, there's like, it comes in a gallon jug. I didn't know, thought you mixed it with water. But so, that was part of it. The initial is to really gain economic freedom so that my family's life would be different than my experience growing up.
Hmm.
But then really that really morphed to, not everybody's going to be able to learn and do what I've done or maybe what you guys have done. And so that's where, that twofold mission really drives me, is one, transforming the lives of investors. Because like I said, there's doctors, attorneys, plumbers, business owners. They don't really have an interest to become an active investor, but they'd love to see their financial life benefit and grow like maybe mine has or your has. And so that's a driving force for me. I want to impact more of those people. One of our investors came to us in 2015 and she said, I want to thank you so much for what you've done for my life. And I said, well, what do you mean? And she said, well, during the downturn, that income coming from you kept my business afloat. She was in a retail furniture business. So nobody's buying furniture in 2008 and 9. They're losing their house, for God's sakes. And then she said, that income, both my kids went to college in 9 and 10. And that income helped put them through college. One became a firefighter, one became a school teacher. She said, I'm fixing to sell my business in the plaza, commercial plaza, and put that money with you. And I'm going to retire to take care of my mother who's dying of Alzheimer's. And she did that. And so that was a moment for me, like, wow, what a God moment, that 3 generations of this family, their life was changed because of the expertise of investing in real estate and what we've done. And so that was a driving force for me to impact more people like that. And then also the residents, like, maybe people don't understand this in full, but a lot of the people that live in the apartment complexes that we buy are just regular working Americans making 30 to 55, 60,000 a year. They're not going to be able to go beyond that rental status in many instances. And so for us, we're driven to want to make it a quality environment to really benefit those people that live there, to have a quality experience, because they're hardworking. They just don't have the tools to maybe scale beyond that. And so those are the 2 drivers now that drive me. It's not really about an economic, yes, we've got to make money, yes, we've got to grow in that respect, but those are the things that really kind of drive the mission for me.
So as you're scaling up the private equity in the company, can you give us a couple tips on raising capital for anybody out there that wants to aspire to become a syndicator? Where should they start? I mean, how do they start raising capital?
Yeah, you've got to start within, I think the immediacy of your, the circle of people that you're dealing with, the network of people that you have, people that you have connection and influence with. And that's where you have to step back and ask yourself, what circles are you traveling in, right? Like, if you're hanging out at the club and this, that, and the other, that's not the right circle, right? I mean, like, so you can proactively begin to put yourself in the right circle of people, whether, it's at church, or if you have a charitable inclination towards, like here we've got the Suncoast Seabird Sanctuary or the Turtle Rescue. I'm not saying you go there out of duplicitous motives. You should have a pure motive about wanting to be a part of, helping animals. But then there you start to connect with better quality people and different people, and your network begins to change. And then now you also have to understand, like, if you don't have experience, then my recommendation is you'd be to partner with somebody that does have experience, right? So that you're not kind of winging it. And then now with that partnering relationship, you have the ability to co-opt their experience. And now you're offering somebody in your network an opportunity where they're able to invest. And it's like, you're not asking them for money. You're presenting them with an opportunity that they otherwise wouldn't have. And if you're delivering a, 12, 13, 14, 10, whatever percent return you're delivering to these people, contrast that with what are the other options. Like right now, we're in a yield hungry world that, the bank's paying nothing. CDs are at 1, annuities are at 4, bonds are at maybe 4. Good Lord, junk bonds are now, 6, 6.5 for crap that they try to label as triple or double B that's really C. And so versus having a quality asset-backed investment that's been there for 30 years with people living in it and producing a return, that's a much more stable investment. So that's where I would say to begin. And then the other thing is, if the person really does want to get into this, as what you mentioned earlier, as a business, then raising money or connecting with people has to become a business focus. There's 4 legs to the stool, right? You have acquisitions where you're buying, you have equity where you're raising money, you have operations, and then you have dispositions. If you have 4 legs to your chair, you're going to have a stable chair. If you only have 2 legs, you're going to fall on your ass. And that's what happens to people, right? They only focus on 1 or 2 things and they lack stability.
I love that. It's like having a bunch of kids. It's like syndication. You've got to take care of all those kids. You just can't have those kids and just we'll move on to the next one. That's really important. The 4 part.
You can't love one.
No, now I want everyone to write this down because this is important before we go to the short answers. Really important. If you're going to start raising capital, look at your network. I want everyone to have a real serious come to Jesus moment. Who are you hanging out with? And if you're not hanging out with the right people, that's your decision. That's your choice. So you can always change your circle of influence. Go to friends and family, but don't go to them until you're really educated and you really know what you're talking about and you can offer them an opportunity. And I think the second thing is business focus. Focus on the business. It's really important that you need to focus on those 4. We call it our proprietary 3-step framework: the buy right, the manage right, and the finance right. You need to focus on those 3 facets of multifamily. Once you can understand those, and if you're starting out, don't be afraid to invest in somebody's syndication. Learn while you earn. That's another fantastic way to get into the game. You have a little credibility. You're part of a deal, and you start learning. And then from there, start learning and start raising capital.
For sure. That's critical because not everybody can take on all 4 of those legs at once, but you can begin to learn, or, within a network like your guys, you can begin to partner with the right people to develop those skill sets. Right. And then that goes back to, well, what do you want your outcome to be? Because like for us, I knew it's like, hey, we're going to be a fully integrated firm. That's kind of always what I've done is build the businesses. And so that's us, but it's not for everybody. But again, by defining it and then connecting with the right people, you can it's not a lack of resources. It's a lack of resourcefulness for most people. Right.
Yes.
And so the resources are there, like to connect with and learn, like with your 3-step process. Like, good God, if you jump in and learn that, now you're off and running towards the direction you want to be and become an active investor.
Love that.
All right, guys, let's take a quick time out to hear from our sponsor.
Are you looking for ways to improve your life?
Here at Jake and Gino, our mission is to empower students through financial education and the vehicle of multifamily investing.
Yes, Jake. We agree that a person with financial intelligence can change the world for the better.
We've created our proprietary 3-step framework: buy right, manage right, and finance right, that we teach to our community. This framework, along with education, our one-on-one mentorship, on-site boot camps, and the amazing community, has propelled our students to massive success.
We've all been there. We've had so many students that have been able to shift their mindset, overcome limiting beliefs, and set a clear path to achieve their goals. Whether you're currently fixing and flipping, wholesaling, or buying single-family rentals, and you know that multifamily investing is the right vehicle for you, I encourage you to visit jakeandgino.com/apply to schedule your complimentary consultation with our team. And I want to let you know this isn't a high-pressure sales call. It's really just a discovery call to get to know each other better and see if we're a good fit for working together. And if for any reason we're not a good fit, our team has tons of resources we will share with you to help you along your journey.
If you're ready to stop spinning your wheels, go to jakeandgino.com/apply and schedule your call now. All right, we are back. Randy, what is your best habit for success?
Best habit for success is developing a daily mindset ritual. Every single day, without fail, without question, starting your day in a systematic same way where you're developing, a mental focus for success. I personally do a time of meditation, prayer, reading. I read the Bible. Other people can read inspirational material, but you're doing that and then going through an exercise of visualizing the success that I want for my day, developing a spirit of gratitude, thankful for what I already have, both big things and small things, and developing a gratitude for what I'm going to accomplish as it's already been done.
All right, someone just completed their first syndication. What tip would you give them for asset management?
Yeah, you've got to set up and focus on performance, KPIs, and accountability, right? If it's not measured, it's not going to get done. And so, immediately they've just closed on the deal. You've got to say, here's what we've scheduled out to be our performance over the next 12 months. Here it is month by month. Here's my management company that's agreed. Here's the budget and the achievables month by month. And then you begin to every week hold on accountability to see that you're on track to hit that month's numbers? And if not, why not? And then if not, what are you doing to change that?
You touched on the resident experience earlier. How are you improving the resident experience for your folks?
Yeah, so we, go in external transformation, 30 to 90 days, make the overall complex look better, lighting, landscaping, paint, whatever those things may be, to make it look better as a better quality place to live. Also identify if there's bad actors in there. Those are the people we want to, move on and move out as we can. And then also then providing immediately better quality amenities. And then a critical thing that people don't measure is maintenance turn time, right? Like, are you on top of it with a responding, like we're going to kick your ass if you're not responding to the maintenance requests and those people are within 24 hours, right? I mean, like that's an internal metric for us. And I mean, I'm a little aggressive about that, but it's like, look, if a person has a problem and they notify the office, they need to be responded to within 24 hours to be able to know either one, it's addressable, or two, it's going to be, oh, it's a thing like that, not life-threatening. We'll be there on Wednesday, 2 days later to fix it, right? And so that's critical that people know that they're being listened to and they're being taken care of. And, and then ultimately we're also developing some other programs that we do with outside relationships, back to school drives and things like that. During this COVID, we had partnerships come in with, when kids were out of school, come in and provide lunches and stuff like that. So we are focused on doing more than just enough, but really treating these people and trying to help empower them.
What was your biggest mistake from your first large-scale syndication?
Not having the accountability in place and being too nice, right? Like I'm a pretty driven guy, and, giving too much rope to the regional manager, instead of being like, hey, I'm holding that rope tight. And so again, I go back to the accountability thing. Look, I'm a smart guy. You guys are smart people. The people that are listening are high quality. You go in and assume, hey, this person's smart. They're going to do it. When you assume, you make an ass out of you and me, right? And it's like, that's not a good move. You got to hold accountability, even if the guy's a rock star. I just had a meeting with my team earlier before the show.
Who's driving the ship? Are you driving the ship or is he? You need to have that vision in place. And guys, I can't stress the importance of what he's saying here. Weekly meetings with the property manager, with the regional manager, whatever the case may be. You need to be nailing that if you're in an asset management position, or it's not going to go the way you want, because you need to be the leader. You need to be the one with the vision, not focusing just on the next acquisition and trying to get a rip. You got to be managing these things for performance.
100%. The thing I was saying is don't accept their crap lack of excuse for as to why the performance not there. Like, okay, for an example, there's a unit that's vacant, has been vacant for whatever 3 weeks. You dive into that. Why is that? Okay, or with your traffic, have you been walking them through this path through there to go see it? Oh no, you've been walking them by the dumpsters. And you've got to understand and hold accountability, not just like, oh, we're working on that. Working on that's not good enough. What's your plan to get that unit rented? What's wrong with it? What's the deal? And, if they don't have the answers, and that's again where I made the mistake of giving a little too much room, where it's like, look, hey, get that fixed and have it fixed by this next week. And I want to see the plan to have that damn thing rented within the next 2 weeks. And that may sound tough, but look, people have entrusted you with their money, and you've got to get an outcome. That's it. There's no two ways around it.
Mm-hmm.
All right. You plugged the Bible already. Give us another book reco.
Think and Grow Rich. The first time I was proposed to that, I didn't like the guy, right? He was a manipulator kind of.
Napoleon Hill?
Yeah, Napoleon Hill. Yep. The guy that said it was a game changer for him, he was kind of a manipulator dude, right?
Oh, that guy.
And so
gotcha.
it eschewed me from wanting to look at it. So probably until a few years later, when somebody else that was more trustworthy recommended it. And then upon reading, it's like, wow, it really does, dive into developing the vision, the right mindset, beginning to conditioning your mind, developing a plan of action. So many powerful things that you really need to get the outcomes you want.
So much from personal development in the modern era has stemmed off of that book. I feel like everyone's taken a chapter from it, written a best-selling book, and made it their own. It's really
it's The Godfather. I mean, really, that was probably the genesis the beginning of the movement that we experience now today, no doubt.
Mm-hmm.
What project are you excited about right now?
Two really we have in the works right now. One is a next door neighbor to the property that we already own that we are on track to get locked up for 22% off of what we bought the existing one for. So that's exciting. And then another that we probably, Lord willing, get nailed down tomorrow, which is a B property in an A- location. And so that's exciting as well. And it's we've had to change our modeling, right? We're conservative in our focus. So like when we're underwriting now, it's like flat income for a year, even though we're making improvements and growing everything. And I know we have kick-ass operations. We'll do better than that. We're underwriting the environment we're in to anticipate that we're not going to do better than that. So if we do better than that, we'll have a rock star situation on our hands. And so those two deals are exciting right now that we're on the cusp of getting.
What's the best way for the listeners to get a hold of you?
You could go to our website, therealestatepreacher.com or prosperitycapitalpartners.net. Either one of those, one's for the podcast and one is for our company. Either one of those have contact us kind of things, and love to be able to connect together and add value to you.
Perfect. Gino, take us home.
Jake, Randy, picture this. It's 1999. Mr. Randy's working in wealth management. He buys a duplex. He invents the BRR method, preceded by Jake, who invented CrossFit. But Randy takes it a step further.
I was doing it out of his garage. That was my, he was renting me the garage. All right?
Jake quit out on the dream. Jake found Gino, and he said, forget CrossFit. I love this multifamily.
Better deal.
It's 2003. Randy says, this wealth management thing, I'm not really feeling it. This financial products, I'm not getting that much juice from it. Goes ahead and buys a 7-unit property. Toils, twists, turns, makes a few bucks from it, makes some mistakes. But then he gets down the shiny object, and it's like me telling Jake to buy crypto. He's buying single-family homes, which is great, which he turns into a business. But then he revisits multifamily, and he ultimately sees multifamily as the vehicle. And everything that he's mentioned, whether it's scalability, whether it's economies of scale, we even touched upon the recycle resiliency of the asset, the tax benefits for the asset. That's why these assets are worth what they're worth, right? He's found it, and it's a great story because Randy's just like Jake and Gino, just like the rest of the listeners out there. He just has a passion to help others, and he knows that he's smart, but he needs a team around him. And you can't do this stuff by yourself. The pie is not finite. The pie can be infinite and continue to add layers on. So it's a great story from going from wealth management to single family to multifamily to private equity. It's a great story. So I just want to thank you for sharing it with us.
Thank you so much. I appreciate you guys and all of my friends that said all the things about you guys in a positive way. They weren't lying. I appreciate the time to be together here with you guys. And I appreciate what you do to help, empower the audience and the listeners. I know you guys are doing a phenomenal job. And so I'm grateful to be on the show with you today.
Thanks, Randy.
Thanks, Randy.
Thanks now.